Thank you for joining us today for our first on-demand webinar. We are with Malecki Financial Group. My name is Anastasia, and today is Get Real About Retirement. Eric will introduce himself, and then we'll get into a little bit of what we're going to talk about today.
How's it going, everyone? My name is Eric Stiles. I'm a certified financial planning professional with Malecki Financial Group, and I help you retire early.
All right. So we're really going to talk about ways to manage your money in retirement. So this is for everyone, not just if you're ready to retire right now, but Eric can really talk about why that even makes a difference. What happens if you're not actually ready to retire right now, and why should you care about preparing for it today?
Well, because for those who are on the younger end, you're usually in a more advantageous situation the more years you have. The closer you get to retirement, the less and less amount of time you have to get your assets compounding and growing. So it might force you to put a lot more of your cash flow towards retirement than if you start younger. It might be a little bit easier on your monthly budget hit if you start earlier.
And this lets you understand what comes next, right? Because if maybe somebody like me, we don't know what's going to happen. So being able to go over stuff like this now, it's not just about getting all the money put together, but it's knowing what to expect. And that's what we're going to go over a little bit more.
Of course.
So we've got the 10 key steps to navigate in retirement. These are just things you might not have thought about before to keep in mind. So we're going to go over them. Eric's the professional here, and he'll tell you what's up. So what about your retirement budget specifically?
So, first and foremost, when you're building your plan, you have to know what your target is, what your goal is. If you can't determine what, the amount of income you're going to want or need, which are two different ones, you got to determine the income you need, and then also you got to also plan for, fun money. And retirement's supposed to be fun. It's supposed to be enjoying, rewarding, and you got to figure that out as well. So, putting together a budget, determining what you need for your, the amount of money you need for your needs, the amount of money you would like to have for your wants, and then if everything goes well, for those that you want to have for your wishes, for your, you got to make sure, we got to figure this out so that we have something to shoot for. So because once we have that, we can then work on determining how much you need to save. What year can you retire? Without that, we can't really start.
So this is a really strong place to start if you're not sure where to go from there.
Mhm.
But of course, this can go with tracking your spending, right? That's something that anyone, regardless of your age, could start working on.
Yes, of course. And these days, there's so many convenient apps and budgeting tools, and there's even a lot of programs out there that you just connect all your credit cards, your bank accounts, and they'll organize a lot of your budget just automatically. And then you might have to go in and do some custom analysis, but this is very important, not just for retirement, but also just in general. Like if you're saving for a new house or your first house, if you're saving for college, tracking your spending allows you to see, oh, maybe I'm spending too much on online shopping or too much on Amazon. We're getting too many Amazon packages. Um, or, maybe, oh, wow, we were actually been doing pretty well. We can send this X amount of surplus off to our 529 plan. We can send it off to our IRA account. So it's tracking it's hard to know how you're doing if you're not tracking the data. If you're just assuming, oh, I think last month went well. I think last year went well. Might be recommends much better off, having something tracked and in place so you see the data.
And then what about if you have some debts that you need to pay off before you can relax for retirement?
So, one of the general rules of thumb is you would ideally like to head into retirement without having any debt. These days it's kind of hard, without, maybe having a mortgage going into retirement, but at the very least, there's a lot of different strategies that you can do with debt. It's, do I pay off the highest interest rate first? Do I pay off the lowest balance first? Do I keep this debt open because of the low interest rate and I can potentially gain a higher rate of return on an investment? It's a lot of things to consider, and unfortunately, in my opinion, there's not one cookie cutter rule because everyone's lives and preferences are different. I talk to a lot of people all the time that maybe even though financially it's more advantageous for them to invest more instead of paying off that debt just because of the interest rate. But for a lot of people, there's a comfort level of knowing that you don't owe anyone any money. And for a lot of people, that's something that's very important. So yeah, discussing debt with your financial professional is very important, and it's going to be unique to your specific situation and preferences.
And then what about emergencies? Because I know that sometimes that can cause those debts to build up. You got to have a plan, right?
Usually, you're exactly right. Usually, debts start and is because of not planning for the unexpected. Of course, you have your car loans that's not, I mean, unexpected. You know you went and bought a car, or you know you went and bought a house, but what happens if the AC goes, the water heater goes, and or your car breaks and there's a big repair bill and you don't have an emergency fund set on the side, and now it's like, oh, we'll just put on the credit card and figure it out. Well, unfortunately, with how high interest rates are in credit cards, that turns into, we have so much debt. How do we get out of this? And so, one of the ways to help with your debt planning side from the previous slide is to prepare for the unknown. Generally, we recommend having 3 to 6 months of your monthly expenses covered in emergency fund. That's in a savings account, a high yield savings account. That's in a cash or cash equivalent setup. It should not be invested in anything really. It should be something safe, secure, stable that you can use in those emergencies. And, you know, if an emergency does come up and you have your emergency fund, don't hesitate to use it. Yes, go and use it. That's what it's there for. And then once you use it, your first objective should be to refill it as fast as possible. And, just as a rule of thumb, don't assume that emergencies aren't going to come up. It's normal in life for it to happen. Expect the unexpected and just be ready for it when it comes, and you'll be grateful, when it happens.
But then reeling it back towards budgeting and stuff along those lines, right? You should be looking for ways to cut expenses.
No, yeah, of course. And you see one of the first ones listed here. When a lot of people are getting towards retirement, it's, they've had the family home where they've raised their kids, their family, now their kids have gone and, went to college, they're onto their careers, they're now moved out, maybe started their own families. And it's like, we have this big house, we have all these rooms that are not going to be used. Well, some people it's very important, like I bought this house. I plan on living the rest of my life in it, which is excellent. But for others that don't really have the attachment, a way to really boost your expenses and also maybe get some equity out and put it towards retirement is you could look into downsizing. And I think that's for a lot of people that's a normal way of life. But other things, of course, you have all these days every single company you work for is a subscription. I'm sure a lot of these subscriptions, you got to really think long and hard, like how often do I really use them? And, for a lot of people, I think one of the biggest budget items that, you could look at cutting down is cooking more at home. For a lot of people, whether it be takeout, going out to restaurants, that's a large part of people's, cash flow sheet. And really cooking at home and trying to, do more in-house can really help save on your monthly cash flow budget. So, there's, obviously going back to the tracking, it's hard to know where you can cut if you're not tracking your expenses. But once you start tracking your expenses, there certainly can be certain things that are pretty eye-opening of like, oh, wait, we're spending that much on this. And then it could be a pretty straightforward way to kind of decide, oh, let's cut back there. So there's a couple of ways you can look at cutting back expenses.
And then what about your insurance? I know, Eric, you know more than I do about life insurance, for example, but what about having enough coverage going into retirement?
Yeah, so going into retirement, it's a unique thing to kind of be ready for. I'll touch on life insurance first and then health and long-term care. So, life insurance, a lot of people have different opinions on it, but in my opinion, that the number one reason why you have life insurance is to protect your loved ones from loss of income if something would happen to your life. Well, but when you go into retirement, you are deciding, I don't need income anymore. I have enough assets that they can produce the income for me, or whether it be assets and a pension and your Social Security. And so, for a lot of people heading into retirement, the need for life insurance goes down greatly because one, you don't have to replace income anymore. Two, for a lot of the people, like I said, the kids are grown up out of the house. You don't have to worry about your spouse, raising kids without you on a single income. And so for But for others that, whether it be business owners or other reasons, life insurance can be important. So I think for a lot, life insurance the need for it starts to go down as you get towards and into retirement, but doesn't mean that it's not necessary for everyone. For some people, there still is a need for it. And then as far as health insurance, when you hit 65, you have the options for Medicare, and you got to consider also, do I get the drug plan? Do I get Medigap? Do I get Medicare Advantage? It can be very, very complicated, but working with a financial professional that knows it well, they can definitely walk you through the steps at with more confidence. And but also, talking about I like to help people retire early. That's something you need to factor in for. If you retire early, there may be a gap between not having your employer covered health coverage and Medicare. And we need to plan for that higher expense of getting private health insurance to kind of bridge the gap between the two. And so, health insurance, it's of course, it's not difficult to understand. It's very important. And but one of the big things is heading into Medicare. Make sure you talk to a professional because during that initial enrollment period, that's where you want to get it right the first time because potentially there's additional premiums and penalties if you have to adjust your plan later on past the initial enrollment. And then lastly, long-term care insurance. It's a very unique insurance where, for a lot of people, there's a concern, what if I go into a nursing home? What if I have to go get a home health aide? And those features can be very, very expensive. And for a lot of people, you have the upper class that they're they can be self-insured for it. You have the lower class that they're closer to getting with the Medicaid area, and then you have the middle class, which a lot of people are in, where they're in a tough situation. It's, do I purchase long-term care insurance, or do I not, and risk having to drain all my assets and my loved ones not receiving any inheritance? And for some people, leaving inheritance to their loved ones is not really important. For others, it is very important, and that's where you should consider long-term care insurance. I'd be careful. I think that industry is ever evolving and changing a lot, and because the cost of long-term care is rising so rapidly, you really got to make sure you're getting the right insurance product that is going to be the most cost effective for you.
And of course, a question that everybody's going to have going into retirement, what about their taxes? How is that going to impact their income there? And what can they do about it?
Yeah, so everyone I've ever talked to loves the IRS and loves taxes. So but no, really, but really, obviously, everyone wants to minimize tax as much as they can and keep as much of money as they earned. And there's different strategies for when you're withdrawing your retirement savings that can help minimize it. We have to consider how much pre-tax retirement accounts assets do you have? Do you have any after-tax Roth assets? Do you have just regular taxable non-retirement investment accounts? And so the coordination of all of this is very important, and working hand in hand with us, your financial professionals, and also your CPAs is of the highest importance. And so, it's hard to avoid taxes, but there are ways that we can try to minimize it. And it's an order of operations of taking distributions, and so it's obviously we're not tax professionals here, but like I said, we work hand in hand with CPAs. We try to do the best we can, and it is a very important point to touch on.
So I know we went over this one specifically in one of our previous webinars about Social Security, but really briefly, can you talk about when to start claiming Social Security or using it as a source of income?
Sure. So the earliest you can take Social Security starts at 62. The latest you can hold out while maximizing your benefits is till 70. If you don't take it, best past then, you're not going to get the benefits increase at all. And then there is a full retirement age, depending on when you were born. Could be 66 and 10 months, could be 67. It depends on the year you're born. Generally, now this is a generalization, and I highly recommend, and we do this with all of our clients, that you work with your financial advisor and with your financial plan, and you run all the scenarios of every single year and determine which one produces the highest success rate. You know, that's first and foremost. I recommend that as the first recommendation. but as a general rule of thumb, if you plan on living a long, happy, healthy life, and if your family history, your parents, grandparents, their parents, you have a long line of living long lives and in your lineage, generally, the longer you wait, so wait until 70, it does tend to lead more confidence in your financial plan. And the sooner you take it, kind of the opposite. For a lot of people, Social Security, just like taxes, is a very hot button topic. And it's like, I've been paying all this, every single paycheck throughout all my working life. They've taken money out for me. I want to take it as soon as possible. I want to take it as soon as I can at 62. My comment to that is work with your financial advisor first and determine what the success rate of your plan is if you take it then. I at least would like everyone to have the knowledge so that they can make an educated decision on when to take it. Because, for example, let's say we run in your plan. Taking it at 62 gives you, an 80% success rate. Taking it at wait until 70 gives you a 90% success rate. At least when you're making that decision that you are consciously, targeting your plan to have potentially a 10% lower success rate because you would like to take it as soon as possible. So so to kind of sum it up, work with financial advisor, number one, so you can get an accurate a more confident representation of the success rate against your plan and different options. But if you want to go by rule of thumb, generally, the longer you wait to maximize it at 70, from our point of view, would lead to a higher chance of success. Because, it's funny, everyone wants to live a long, happy, healthy life. But for your financial plan, that's actually something that's stressing your plan. That's more years we have to have your assets grow. So from my point of view, I would like to use the strategy that is going to plan for a higher confidence level if you're going to live a long life. And so that's kind of where I'm with Social Security.
So sticking with talk to your financial advisor, what about asset allocations and how that might change going into retirement?
Yeah, so leading up to retirement, your asset allocations will probably be set up in a way where the number one goal is capital appreciation and long-term growth. Trying to grow those assets so that you can say goodbye to the paycheck and my assets are enough that they'll provide me a paycheck. And so, we generally recommend having you should have a different asset allocation in retirement than what you did leading up to retirement. You shouldn't be as aggressive. We should be considering investing in more products that generate an income. We shouldn't be doing the same thing we did because the goals are different. Leading up to retirement, the goal is to grow the assets. In retirement, the goal is to receive income and have the assets to last the rest of your life. So we should revisit honestly, you should be revisiting it leading up to retirement, but especially if you just retired, you should revisit it with your financial advisor.
And I think this might be our last one. What about rebalancing your portfolio? Changing that weighting among the assets you might already have.
Yeah, so what rebalancing really comes down to, it's a automated way to do the whole mantra investing of buying low and selling high. So if you come to us, and let's say your retirement, we recommend asset allocation where you put, I don't know, let's make it easy. You put 50% in investment A and 50% in investment B. And that's the sweet spot that we think for you, your goals should be a 50-50 split in this hypothetical example. But over time, let's say investment A does a really good year, and it's now making an investment B kind of short a little bit. And now investment A is 60% of your account, investment B is 40%. The whole purpose of rebalancing is, and generally on a quarterly basis we do it, it's trading back to that original model. So it's selling high out of option A and cutting it back 10%, and then taking that 10% that you sold high, you captured your gains, and buying low into option B that might not have done that well in that given time period. When you have a diversified portfolio and diversified asset allocation, not all of your investments are going to be moving in the same direction at the same time. That's the whole purpose of being diversified, is that you're more balanced and more spread across multiple buckets. And so the reason why we rebalance is because we want to make sure that throughout your entire retirement, we're still trying to target that 50-50 split. Because if you let it go untouched and you never, you set up the investment, you never touch it again, that initial target allocation of 50-50 can start getting really out of whack. And, next thing you know, you're misallocated. And next thing you know, maybe you have too much in stocks and now you're too aggressive for being in retirement. Or maybe you have too much bonds and you're not, they don't have enough in stocks and you can't keep up with inflation anymore. So the purpose really of rebalancing is revisiting the original target model and making sure that, on a quarterly or, sometimes annual basis, we rework it to get back to that target level that we were trying to pursue.
And of course, you should do this with the help of your financial advisor,
Yes,
as with
yes,
most of the
that
things here.
definitely. If you work with us, it's something that it's we automate, we take care of for you. But yes, it can get a little complicated. So if you're doing it by yourself, just be careful. And we always recommend running by a financial advisor first.
So I think that's it from us. Eric, if there's anything else you want to add to make sure that we share for getting real with retirement, but I think that's it.
No, I think that's pretty much all I want to say. I guess my final thought, I kind of mentioned a little bit throughout, is that there's not there's not one magic rule that applies to everyone. Everyone's different. They have different preferences, different likes. There isn't one magic number that if you get this much, you can retire. Because you know, someone might want to retire at the beach with a beach house. Another person might be like, I don't need a beach house. I just want to retire in the house I've lived in my entire life and just, and be around family. And so it's just try to be careful when you see, whether it be online or YouTube, that, oh, this is all you have to do to retire, because everyone's different. So that's why I always recommend working with an advisor, because they get to know you, your personality, your preferences, your goals, and they can tailor a plan to you and not a cookie cutter one that's supposed to be blanket over an entire group of people. So that's the final kind of note I have, is that just be careful with what you see online, and just because it worked for one person does not mean it's going to work for another person.
That's pretty sound advice right there. So thank you guys for joining us. If you have any additional questions after this, our contact information is on the screen, and we'd be more than happy to set up an initial meeting with you, right, Eric?
Yeah, of course, we're always here.